The Financial Survival Network, helping you to survive and thrive in the new economy. This is the Financial Survival Network.
Financial Survival Network is presented to you by Regal Assets. Buy and sell physical gold and silver through your existing retirement plan, 100% tax-free with Regal Assets. If you want to include physical gold or silver in your existing IRA or old 401k, request your free investment kit, which was recently featured in the Forbes and Smart Money Wall Street Journal magazines. Call toll-free 855-678-6620, 855-678-6620, or visit regalassets.com. We're living in a time that is so uncertain. We all know there's going to be a collapse, but some people think it's going to be a deflationary collapse. Other people think it's going to be an inflationary collapse, and some people think it's going to be both. Well, I've got the master trader, Vic Sperandeo, on with me now, a.k.a. Trader Vic, friend of the show, one of the first interviews we did on FinancialSurvivalNetwork.com. Perhaps Vic can clear up some of the morass. Vic, welcome back.
Nice to be back. Thank you.
Hey, a pleasure to have you. You're a true gentleman. You followed my heart. You got out of New York. You're in freedom-loving Texas. So what are we going to have here? Do we have a case where I just got off the phone with Martin Armstrong, well-known real cycle pro, and he says you can't have hyperinflation as long as there's a market for the country's bonds. My feeling is, well, 61% last year of the national debt was purchased by the Fed, which means the lender of last resort. And, this year probably less will be purchased because a lot of flight capital from Europe, from the fear of the Euro breakup, is heading in to the U.S. into government bonds. But just what's your feelings on that?
Okay, well, that is true to the degree that we are looked at as a safe haven because there are countries that are in much worse shape, i.e. the European Union, and money is flowing out of the European Union because that is more imminent a collapse than the U.S. So temporarily, we're the cleanest, dirtiest shirt in the dry cleaner. But the point is that is a temporary phenomenon, and I will bring this up to you. The key to why people buy our bonds is, and this is not speculation. I'll tell you when I'm speculation on my calls. The CBO report, that is a 10-year prognosis on what is going to happen to the budget. It's the official report. It's nonpartisan, that comes out of government, but it is partisan because the CBO just is a calculation agent. They're an accountant. The numbers are fed in by the administration. Now, every single one of these reports, and I've read them since 2010, they basically are way, way off their projections. However, if you read that report, now it's about 200 pages of numbers primarily, so it's a boring thing to read for sure, unless you're a numbers freak like I am. But when you read that, what you're seeing is make-believe fantasy land projections. Now, I'll give you an example. They basically look at unemployment going down below 5%. I think it's 4.1 for a number of the next 10 years. They look at the budget deficit going to virtually zero, and that's the key to bond buyers. As long as they think the future is rosy, they're not worried. Okay, so you're getting a lot of bond buyers, and they're not people; they're institutions, they're pension funds,
sure,
and they're mutual funds. They're not human. I don't know one person that's buying a bond, and I know a lot of wealthy people. They either buy munis or they're in stocks in general. So, I mean, I'm talking about the average wealthy guy that I talk to. So this is all Fed institutions, foreign governments. if China, and this is the danger, if China just decided it wanted to get back at the U.S. for some reason and says we're going to sell the trillion and we're going to buy stuff, meaning gold and copper and aluminum and the things they need in China, who's going to take over the trillion? Obviously, the Fed would have to take over the trillion. So now the Fed's balance sheet, instead of being a 2.83 trillion, would now be 3.83 trillion. And by the way, it was 700 billion in 2007. So it's grown, let's call it at a 400% pace in 5 years. In round numbers now, don't hold me to the exact numbers because
Sure.
I'm just estimating. But the key here is these future projections. Now, let me give you one other projection that is making this happen. Number one, they're suggesting that taxes as a percent of GDP is going to be over 20%. Now, we only had 1 year where it was over 20% by memory in the last 40 years. But they're saying because of this increase in the elimination of the Bush tax cuts, that it's going to be over 20 for the next 9 years. Now, there's no hope for that because it didn't matter what the rates were. People change their behavior.
Of course.
They don't pay that much. But more importantly, the worst statistic in this projection, which again is making these projections and people who understand the future are looking at this, and remember that pension funds, it's not their money. It's some CIO who's got a job, and as long as he can justify and put in his file that bonds are, we're going to budget deficits going down, he doesn't care. So what the projection is that we're going to have 4.1% GDP growth net. That's not gross GDP. That's net GDP after inflation from 1914 to 1917, 4 years.
Yeah.
Now, let me just tell the audience here that if you look back 50 years, there has been one period in U.S. history where we exploded with growth, and that was 95, 99, or 96, 2000.
.com, boom.
The .com and it wasn't only .com. It was telecom. It was cell phones boomed. It
Computers.
was the laptops came into play. It was many, many different things that were all technology driven that caused that boom. The S&P compounded in a 5-year period from 95 to the end of 99 at 28.5%. I mean, it did a Mike McGuire. It beat the record, which was in the mid-50s, by 20% a year compounded, the greatest S&P period in history. So naturally, and that's how Bill Clinton balanced the budget. He didn't intend it; it just happened because of the times. But the key was in that period, we had, if you take away inflation. Now the government uses what's called the implicit deflator, which is a fudged. They're all fudged numbers, but this is especially fudged. It's lower
even
than
for the
CPI.
government, huh?
So if you use the CPI, for example, and you said, okay, GDP is 6% nominal, and then you take away the GDP, the CPI, you had 1 year in the greatest 5-year period in American history, as far as S&P is concerned, where you had more than 4% growth. And here, the Obama administration's feeding the Congressional Budget Office with numbers that is basically saying we're going to have a 4-year 4.1% GDP with collecting more than 20% in taxes per year of GDP. See, this is impossible.
Can't happen.
But if you're a pension fund manager, which is where the money is, you look at this and you say, okay, it's not, I have a job. It's not my money. I don't care if it's true or not. I can buy bonds. So why you're not, the whole point of hyperinflation is that when you go into a down period, the bond buyers see if you're projecting huge budget deficits as a percent of GDP and a huge borrowing process that the government has to borrow 50%, let's say, of what it spends. It's been borrowing 40 in the last 3 years. What's going to happen is bond buyers will back away. They have no choice, like these pension funds, because they are personally liable, by the way. So they have a prudent man rule. But as long as the projections are rosy and it's government numbers, they can't be sued, you see? Mm-hmm. So you're going to get hyperinflation after the euro problem dissipates in I'm calling 2014, two to 3 years. What will happen is you will come, now again, it does depend on who wins. I am a big political, let's say, what's going to happen politically can change the outcomes to a degree certainly for the next 4 years. But let's just assume the same thing. Let's say assume the president wins, and if he does win, 2014, you're going to run into a depression scenario, and you're going to run into, this is with the fiscal cliff, and you're going to run into huge deficits that are going to astronomically knock these projections out of the water. So I'm only saying that the confusion with most people about deflation and inflation is that from deflation comes hyperinflation. When you have deflation, you have let's say a slow economy, budgets go out of control, they go up as you've seen. The funding of those budgets have to be met by people willing to put up their debt. If you look to Europe, Greece got funded for a number of years. Now Greece can't get funded, okay? And Greece can't get funded because the Eurozone is not giving clear signals it's going to continue to fund them. So when buyers back away, then you get rises in interest rates, which is normal, and then you get to a point where if the deficits are so bad like they are in Greece, people just won't buy the debt, no matter what. Right. And that's where you get hyperinflation because the Fed will print.
No doubt they're going to print, and because that's their job, right? I mean, they are the lender of last resort.
Well, in this case, they wouldn't even use that phrase. They would basically use the phrase, it's their mandate, because their mandate is full employment. They would rather use that.
Yeah.
It's not necessarily the banks that's going to borrow from them. It's everyone, you see. And if people don't let's say, not able to buy the Treasury's bonds, it's still their mandate to create full employment, and it's according to them, and the law, and they would do whatever it takes to get there.
Mm-hmm. So this thing is unavoidable. It's just whether it happens in the relatively short run or if it happens a little bit more in the intermediate run, which probably is somewhat dependent upon the outcome of the current election. We don't really talk about politics a lot, but here, obviously, politics is going to make a big difference in this.
It is in the short run for sure. Now, I will say this, and I don't mean to sound as gloomy as I'm sounding, but let me just say that this is my business. What I my global macro. If people know me, I'm not a stock trader per se. So if you ask me, should you buy Microsoft or Intel, I wouldn't be able to tell you.
Sure.
My business has always been trading commodities of late and global macroeconomic calls, and I'm an Austrian school thinker, so I use those reasons. But I mean, to make my decisions, I use an Austrian school foundation. I don't use a Keynesian foundation of outcomes.
Yeah.
But what is the critical part of the future is that no matter how you construct, reasonably speaking, 10-year numbers, there's no way the current government can win. I don't care what your projections are or what you do, or if Romney wins, there is just no way to get out of this. Now, let me make my case to that, because that's important on this call. And the bottom line is, first of all, like I say, you should have 5 to 10% of your assets in gold and silver. I mean, that's the bottom line. That's
always
your hedge.
Always, right?
Always. 5 to 10%. Now, the reason is, let's assume the election comes about and Romney wins and the Senate is 60% Republican. And all of a sudden, all these great things happen. He stops Dodd-Frank. He stops Obamacare. He cuts taxes 20%. He lowers spending 1% a year for 5 years, so you get GDP down to 20% again of GDP. All these phenomenal things that are highly unlikely, but let's assume for this conversation they happen.
I got my
pardon me?
I got my Panglossian view of the world here. It sounds wonderful.
Okay, well, I'm making this up now.
I know.
So then, but let's assume 20 million of the 23 million people get jobs. Now, let's also assume that they get jobs in the higher third, lower fourth quintile, which means they're going to make about $75,000 a year. All wonderful. Well, they're going to pay $10,000 a year in taxes. If you go to the code, and assuming the code is what it is today, that's 10,000 times 20 million people. That is $200 billion. Now, doesn't sound like a lot when you're talking trillions, and it isn't. And that's the most rosy scenario possible, but here's what happens. Every time interest rates go up 1%, they average now, the average rate for well, let's give it to you this way. It's 6% of GDP. Interest we pay is 6% of GDP. And it's averaging somewhere in the 2.9% arena. 1% increase in that average brings you $160 billion in interest payments. You just wiped out 2%. You've more than wiped out full employment tax collections. You see what I mean? If you play
Sure.
with these numbers, and by the way, the CBO they estimate between 4.5 and 5.5 average interest rates in 10 years. So you see, what happens is interest as a part of of the budget goes from 6 to 22-23%. You see how you can't win? I'm sorry to hear say this. but
it's arithmetically impossible.
And now again, I may be missing something. I don't think so, but I could be missing something. Maybe we have a new a .com sort of phase, which would certainly bring in a lot of capital to the government, taxes to the government, even at lower rates. So that's always possible. That I'm not putting in the scenario, but it's very difficult if you're a long-term thinker, if you play with these numbers in various ways, to come up with a scenario where the U.S. under these conditions can survive. Now, if you privatize Social Security, if you got rid of Medicaid and pushed it all to the states, and in effect it made the government not pay it, if you changed Medicare to a free market system and you subsidize it with vouchers, kind of like what Paul Ryan has recommended, and you could budget for it, you eliminated the rest of the budget to a degree of 1% a year for 5 years, well, that would be a different story. But you see, these are all impossible the way politics is played today.
Yeah, everybody has to get theirs, right? And that's all they care about, and the country be damned.
Correct.
So we're looking at some really unpleasant choices that are going to have to be made, and eventually it's either going to be hyperinflation or a massive debt default. Either alternative is certainly disruptive, although probably the default is better than the hyperinflation, because at least you still have a currency. And at that point, I guess the banks get wiped out in either scenario, because if there's hyperinflation, the money's worthless, their assets are worthless. If there's a debt default, all these bonds they're holding on their books are worthless and they're out of business. So any solution is going to wind up with a replacement of the financial sector with something that's more efficient, hopefully, and more responsive to its traditional purpose, which was to raise and allocate capital to businesses in order to invest and grow.
Correct. And all of that is true. And as I say, the difference is if Romney wins, you postpone these things a little longer. I would be, by the way, very bullish on equities if Romney wins, assuming the House and the Senate are Republican. I think they're going to create an environment that people are going to go use the reserves that are available in the bank. There's almost $2 trillion in reserves.
Right.
And you will get a lot of wealthy people borrowing money at these low rates. So the economy will boom, in my opinion. I think stocks will boom simply because you won't have these or let me even be more blunt, Marxist, socialist agendas that are in the way. And that's what they are. I mean, Mr.
Sure.
Obama is a Marxist, and he is right now mostly doing socialistic concepts that if you look at Europe, you'll see why they don't work. I mean, they just never work.
They've never worked. They can't work.
They don't work. And even if you studied, if you tell this and you're in a debate, you always bring up Sweden. And if you study Sweden, they do pay high tax rates, but it's the corporations that do incredibly well there. And their biggest companies are corporate, they're corporations, and their tax rates are very low. So most successful people incorporate in Sweden. So I just bring that up. That's kind of an aside. We don't have to go there for now.
Sure.
I'm only saying that the European model is just never going to work.
It can't work.
It can't work because, I mean, look at what France is doing. They're going to tax people 75%. I mean, every single wealthy person in France is going to wind up moving somewhere else and getting out of that. They're not going to do business in France. But anyway, let's get to more. What would be another question that you'd have that maybe would be of interest to your audience?
Well, if you're Joe Sixpack and you've got a limited amount of funds to invest, where's the best place to go? What do you do? Because you've been decimated.
Okay. Well, I would say, first of all, you need diversification. All right. So you need, even though bond yields are so low here and the projections, like I say, the U.S. bond market is safe temporarily. But I would say currencies, anybody can open an account in Canada, for example. Canada pays 1% interest. You get zero here. So have some money in Canada. I mean, this is not a hard thing. It is some time consuming. You have to fill out a few forms. You have to do a few things. But you can put some money in Canada and get a decent interest rate and hedge the dollar risk. So that's easy to do. I would say do the same thing in Australia, but it's very far away and it's not as easy to do. So you have some Canadian dollars in cash. Number two, you have a commodity portfolio. Like, for example, the grains did very well. So you got to have a commodity, if you will, allocation. I would say as much as 20% in commodities, because hyperinflation or inflation is going to really help that basket. I would have some short-term U.S. As well, as much as I am bearish on the U.S., but I'd have diversification that way. I'd have maybe a 30% portfolio of stocks, but I'd have some Hang Seng, I'd have some DAX, I'd have some NASDAQ, for example, in U.S. Now, again, how much? Maybe 10% of each one of those countries. I'd have 10% of gold and silver, or a little more, not much more under these conditions, but say 10%. And I mean, I think you get the gist. The diversification here is the name of the game. Some hard assets. I can tell you, living in Texas, I invest in guns. You wouldn't believe how guns that are collectibles, not the ones that Smith and Wesson produce every day, how they have been appreciating. It's been pretty uncanny. But you don't have to use guns, and you can use other things. You can painting, artwork. Of course, you got to know what you're doing there. You've got to potentially use antique automobiles. I mean, these are a bit esoteric. I'm just saying that they have done extremely well.
Right.
I would also own some real estate, but I would own it in states where the real estate laws are very permissive, and I wouldn't own real estate, for example, in California. I wouldn't own it in New Jersey. Now, if you're lucky enough to own a condo in New York, that has already appreciated a great deal. That has done real well because it's a limited supply, and that's one of the key things. But you could own a little real estate. Now, again, I'm getting way off base here because people have limited funds generally, but you can buy REIT stocks.
Right.
They're not bad to own as long as you buy, a small amount, 5%. That could be your real estate position.
Yeah, resource
so those
stocks
are the things
too.
that I'm suggesting that people do to protect themselves.
Right. Makes a lot of sense. So, Vic, to find out more about you and find your writing, where do people go on the web?
You can just Google, Trader Vic. I have books out there, but again, I'm not necessarily trying to sell anything here, but you can find out, what the books I've written, which are now over 20 years, they're really what's called classics. John Wiley's the publisher. They still are selling very well around the world. They're in 7 languages. And there's a couple of, things you can find out on the website if you want to read up on some of the things I've written in the past. They're all there.
All right. Well, Vic, thanks so much for being on FinancialSurvivalNetwork.com. And I think we've got a lot to think about now as far as hyperinflation. My own personal belief is there's a certain inevitability about it because it's always happened in history, and I don't think we're exempt from it. I don't think we're different. I don't think this time is different. So I think being prepared for it and being diversified makes a lot of sense and should help people get through whatever this tsunami is going to be like, regardless who gets elected. So, Vic, hey, we'll talk to you again soon, and thanks again for being on FinancialSurvivalNetwork.com.